Can you trust the numbers guiding the world's biggest financial decisions? Jeffrey Gundlach, the bond king, sounds the alarm on the growing unreliability of economic data, warning that the very foundation of market analysis is starting to crack. However, if the data is this unreliable, what does that mean for the next big market move?
Rates.
Well, I think that's up for debate right now. One thing that Jay Powell said, he said, one of the words he used was, we want to be efficient in the way we manipulate the Fed funds rate. And I'm not really sure what he meant by that, but he seemed to be relying a lot on the fact that he has two sets of inflation and jobs data that were going to come in between that meeting last Wednesday and the one upcoming. And it was certainly quite a week for data. You had GDP that came out pretty good, and then you had the Fed meeting, and lots of interesting cross currents at the Fed meeting. And then you had that wild jobs report that kind of changed everything. So I'm actually sort of glad that we took a rain check on doing it last week, because you're right, so many things have come in. I thought that Powell was quite hawkish at his press conference. He actually said, in response to one question, in a way, we are looking through the current inflation data. Otherwise, we might have raised rates. I don't think there was a single question at the press conference about raising rates. It was all about cutting rates. And I thought Steve Leisman characterized the meeting very, very well. He said, basically, Jay Powell said, we are at our employment target and we are not at our inflation target, which I think is a fair characterization by Jay Powell and Steve Leisman characterizing it that way. But then all of a sudden, it looks totally anachronistic, since we had that jobs report with its 100,000 jobs being eliminated or revised away. And so suddenly we have this gap between the Fed funds rate and the 2-year Treasury, which widened out dramatically last Friday. It was about a 25 basis point move down in the 2-year Treasury. So now we're getting at that strained level again, where the Fed funds rate is 70 basis points higher than the 2-year Treasury rate. So the 2-year Treasury is looking for a rate cut. This is very reminiscent of exactly 12 months ago when we had the September meeting, and they had to cut rates 50 basis points because they should have cut them, perhaps with the benefit of hindsight, in the July meeting. And that kind of feels like where we are again. It's not as bad as it was a year ago, where the 2-year Treasury was over 100 basis points below the funds rate, but 70 is quite a lot by historical standards. And so there is talk in the air of, if indeed there is another weak jobs report or revisions lower, people might be talking about a 50 basis point rate cut. We'll see what happens there. So I feel like this data that is coming out is getting much less reliable, and this has been building for a long time. People are saying that the surveys that get sent out to be filled out for the jobs report, only 60% are being responded to, and that's been rising over time. Also, the CPI data is getting kind of suspect. Several years back, about 8% of CPI input prices were estimated. They call them imputed prices. Now it's 35%. It's jumped way up. So 35% in the most recent CPI report of the inflation inputs are just kind of made up. And so people are starting to get really worried about the reliability of a lot of this data. So I think it's almost a certainty at this point, unless we get a mirror image of this jobs report for the next one coming out. I think it's virtual certainty that the Fed is going to cut rates. And in fact, now, even though there's not that many meetings left in the year, we're starting to see market pricing of perhaps as many as 3 rate cuts this year. I'm skeptical of that. One thing I've been consistent with all year, starting with the January conversation we had, Scott, is I said I think 2 rate cuts maximum here in 2025. Now, I think that the data has weakened so substantially with these revisions that it's possible that we get a third, but I still think my base case is 2 rate cuts this year. So these revisions are strangely statistically on these, because these job revisions seem to almost always be negative. Biden had 48 jobs reports over four years, and 45 of them were revised lower subsequent to the first release. So some people kind of cynically say maybe they like putting a rosy number on the headline because everyone pays attention to the jobs number on that first Friday of the month, and the revisions usually get a little bit swept under the carpet. These were so big, though, that it was
Right.
kind of like a bomb went off, and the two-year Treasury yield went way down, 25 basis points. Interestingly, the stocks recouping more than half, well more than half, I think, of their losses from Friday. The two-year Treasury yield is basically unchanged.
Well,
So that pricing remains intact.